While the Nasdaq is making new all-time high, there's many amazing forgotten growth companies making new 52-week lows. I'm gonna talk about them in today's videos. They were very popular, very well talked about on YouTube, but now not a lot of people are talking about them. So I'm gonna talk about those stocks again, and I really hope you enjoy it as always. The first one is Celsius. I haven't mentioned Celsius in a while. It's been 6 months to a year. The stock is down almost 40% year to date. 40%. This is one of the best performing stocks of all time, at least over the last 10 or 15 years. But now it's down about 40% year to date. Celsius is no longer just a popular Celsius energy drink. They have Alani Nu, which is extremely popular. And now they also have Rockstar Energy. So they have an amazing family of brands. They beat on revenues, massive beat. Also a massive beat on earnings per share, 41 cents versus 30 cents expected. So international sales, as they were expanding in Europe and other places, they grew 55% year over year. So the company is delivering on all metrics, yet the stock is going down. They even now rank as number 6 in terms of the total beverage sales in the world, and they are on the same table as Coca-Cola and Pepsi and Red Bull and Monster. I mean, you never imagined Celsius coming up to those levels. I remember seeing the stock years and years ago, and I was like, this industry is too competitive. There's no way they can make it, but here they are. So it's been a fascinating story, and they did really well. Now have a 21% market share. So the question is, if the business is so amazing, then why is the stock going down? Well, very recently, Costco has announced that they're going to enter the beverage market, and they're going to have the Kirkland energy drink or sparkling energy drink. It's becoming extremely popular. And after that, Celsius Holdings has started going down like never before. Now, it's not just about the taste of it that a lot of people like, but a lot of people love the prices of those energy drinks at Costco. Now, the 24-pack energy drink of Costco costs about $17 in total, or about 70 cents per can. If you compare it to Alani Nu, which is a drink that Celsius sells, it's at $2.57. From 70 cents to $2.57. The Celsius pack is at $18, okay, which is about $1.50 to $1.55 per can. Red Bull is at $1.62 per can. So even the cheapest one, which is the Celsius drink, is still about 100% more expensive than whatever Costco is selling. And people told me they taste really well. So you're getting an amazing taste. You're getting an energy drink for 50 to 70% less. That's of course is gonna become popular. That's of course gonna introduce a lot of competition. That's of course gonna ultimately take market share from Celsius and Alani Nu. Although some people that want to pay up, they're gonna pay up for Alani Nu and Celsius and Red Bull because this is what they're used to drink. Just like back in the day, there was a Coca-Cola test where people were just testing Coke, and then they drank Pepsi. It was cheaper and other products, but they just love Coca-Cola, so they decided to pay up for Coke. So many people in this case, they will pay up for their favorite drink, but some people will be tempted to try out this energy drink at 70 cents a can, and maybe they're gonna like it. Especially in today's economy, they might very well like the drink. So I think that's warranted. Maybe it's not warranting a 40% drop on the stock, but it definitely warrants some kind of a decline, you could say. Now, I believe the Alani Nu brand has been extremely successful. The total portfolio for Celsius grew about 30% over the 13-week period. It's still growing massively, okay? Now, the Celsius drink, the legacy drink, only grew 6%. That drink used to grow 30, 40, 50%. Now it's only growing 6%. Alani Nu is growing 100% year over year. This drink is becoming extremely popular. It grew 100%. Rockstar Energy, it's actually declining. It's down 13% year over year. But Alani Nu is killing it. There's no doubt. It was an amazing acquisition. And what really surprised me is that didn't really dilute shareholders a lot. Shares outstanding barely went up by 30 or 40 million, not even like 25 million. That's really nothing to acquire a company like Alani Nu and fuel their growth much more. So that was without a doubt an amazing acquisition. Now, if you look at the multiple of Celsius, is trading at 19 times earnings. This is a company that used to trade at 80, 85 times. As of recently, used to trade at 30, 40 times not long ago. Today, you could buy Celsius at 19 times earnings, and the growth is expected to decelerate to like 9%, 8%, 7 to 8%. But still, I mean, 19 times earnings. I think Celsius is very well priced. So I believe the stock is actually undervalued over here, but it's not my favorite stock to hold for the long term. And the reason for that is I would compare it to something like Lululemon. So now people love Celsius, okay? Before Celsius, they used to love something else, okay? After Celsius, maybe they love Alani Nu. After Alani Nu, they might love some kind of a new drink that became popular on TikTok, and everyone wants to try the drink. And then Alani Nu loses sale overnight, just like what happened to other legacy brands. So this is a fierce market. It's extremely hard to predict consumer behavior and what is going to be the next trend. Same thing with Lululemon. Now it was popular, especially in COVID. Now it's not as popular, and you have Alo, and you have some kind of brands, and in a few years you're going to have something else. It's the same thing with energy drinks. So for me, I don't like to hold them for the long term because it's really complicated to predict those trends. But I think in the short term, the stock is really undervalued, and I think the market has punished it much more than it should. And by the way, I'm using Fiscal.AI to come up with those charts. If you want to try it out, they give you 2 weeks of free access if you use my link in the description. The second one, which I haven't talked about in a while, is Elf Beauty. Elf Beauty is down 28% over the last year. 28%. That was again a popular stock. It was one of the best performers, and it's been going down. It's down 28% year over year. Now you look at this one, it pretty much destroyed the expectations. They did $1.24 versus 72 cents expected. They also had a decent beat on revenues. They even raised guidance by 40 to 50 million. Total sales grew by about 38%, and the stock is going down. And people wonder, why is the stock going down? And this is kind of the same story with Celsius. It's the same story with many stocks, that a lot of those stocks, they become popular. Like if you look on Elf is on every shelf. You go to Walmart, it's in Walmart. It's at Target, it's at Ulta Beauty, it's at Sephora. It's in every single store. Like it's really hard to expand once you're in every single store and you're so well known and you don't have a pricing premium. So Elf Beauty is known for having lower prices. It's not like maybe it's Dior or whatever, they can command a higher price. They're well known for quality at a lower price. So once you expand in all those stores, you're pretty much done. What are you going to do next? So they acquired another company. And the growth, most of the growth came from Rode, which they acquired. It contributed 36% to overall growth, and the growth was about 38%, which means organically the company only grew 2%. 2% organic growth, So unless they found another acquisition, the growth is pretty much done over here. It's really, really bad. You look at unit volumes, they were flat on the quarter, flat. That's not what this company used to put up. But again, there's more competition and they're pretty much everywhere. Now, they still have international expansion. They're only 20% penetration right now. They said the global competitors have a 70% share, like 70% penetration. They only have 20%, so maybe they can grow internationally. But still, I mean, because this is a company that I believe the growth has likely peaked, you could say, and maybe it could still grow from here. But I have to admit again, the acquisition was a success. They paid, I believe, the right price, and it was a major success. You look at gross profits, this is a massive improvement from 253 to 347. Net income grew from 17 to 39 million dollars, and that's including 12 million of an interest expense because of the acquisition. Now, once they pay it off, it would have been like 52 or 53 million versus 17 million in the prior year. So the company is doing well, they're managing it well, they're managing the tariffs well, the acquisition well, they're doing everything. But it's really not their fault that they became so popular and they're pretty much on every shelf. So unless they find another acquisition, I don't expect crazy growth from the company. But if we look at how much we're paying, you're paying 16 times earnings, guys. 16 times earnings for the stock was pretty much unbelievable. I mean, it used to trade at 60 times and it was like the best stock ever. Well, now trading at 16 times earnings. I think 16 times earnings, to be honest, is well priced for a company that will likely grow 2 to 4% a year in sales, maybe 5% a year. And maybe they could do more acquisitions, they can expand margins. So I don't think the stock is expensive at all. If I had to choose, I would choose Celsius, to be honest. Elf Beauty is not really my favorite. I would choose Celsius. I think they have a much better management team, and I think they have much longer runways in terms of international expansion. And they also have a good eye for spotting new trends and being early within those trends, or else Celsius would not have made it to where it is today. So I would prefer Celsius, but ELF is also undervalued. And that was just my opinion on those stocks. Hope you enjoyed it. It was not financial advice. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.